Welcome to Card Table Commentary, where we try to explain how the old economics turned into the new economics. I'm your host, Seymour Peterson. In the last installment, we talked about the 90s, the fabulous 90s, a period of unparalleled economic growth and investment performance. The president, Congress, and the Federal Reserve were all taking credit for the good performance, and it was a real turnaround from the debt-laden 80s. In the 90s, inflation measured by the Consumer Price Index averaged about 3%, and short-term interest rates averaged about 5%. In another installment, we're going to talk about why inflation was so tame during these years. But suffice to say that investors really like predictable conditions, and the low inflation and moderate interest rates were just their cup of tea. Realistically, Chairman Greenspan's most important contribution during the 90s was to smooth over several financial crises that happened in those years. In 1984, the Mexican peso crashed. In 1998, the Russian ruble crashed, and the hedge fund named Long-Term Capital, that was managed by a bunch of overconfident MBAs, also crashed, and it was a big fund with a lot of people had money in it. The investors and the 1%, the top income people that get about 20% of the overall income, they began to realize that they were the primary beneficiaries of the Fed's monetary policy, and it comforted investors to not have any surprises in store for them. The bond market vigilantes that we talked about in the last installment, that their job was to try to keep the Fed on a non-inflationary track. They decided that their job was done, and they pretty much disbanded during this decade. The incredible investment gains during the 90s spawned a bull market culture. People began to believe that the real path to riches and prosperity lied in investing, and not necessarily productive work, and that the responsibility of the Federal Reserve was to nourish that culture. In the 90s, you could say that the Federal Reserve started to operate under a triple mandate. They were supposed to be concerned with maximizing employment, but they also should be concerned about increasing investment values. And then if it didn't get in the way of the other two objectives, they were supposed to try to preserve the purchasing power of the dollar. As a result of the reduced risks apparent in the financial markets, investors started inventing new types of investments and basically taking on more risk than they had before. And this kind of set the stage for the big problems that occurred in 2007 and 2008. Stock market gains for the 90s totaled a tremendous 320% based on the S&P 500. But by 1996, Greenspan must have started to worry about how the market was behaving. And many of the new companies that were brought to market during this time had no profits, and the overall price to earnings ratio of the market went up to historical highs. And finally, in March of 2000, the market started going down, and it went down for three more years, and the S&P held its losses to 35%, but the NASDAQ, which contained most of the internet-related stocks and the new companies that were being formed, it fell a eye-opening 80%. There was a lot of money that was lost in that debacle. And that brings us to the terrible 2000s. But before we get into that tale, the next two installments are going to be about two trends during the 90s. One was the apparent lack of inflation in the face of an expansionary monetary policy. And the other one is what I call the financialization of the economy.